Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. Wanted to talk today a little bit about um, what's going on in the markets today. The big news, of course, is that the Fed raises rates by 75 basis points. Not unexpected. There were some calls for a 1 point raise in there. It's going to take a while for me to digest any meeting notes or speeches that Powell makes here. Remember, though, their messaging is usually fairly exact. They're saying exactly what they want to say, and they're suggesting exactly what they want to suggest. So I think it's always a good idea to pay attention to what the Federal Reserve is doing. There's always you should always go back to the old adage in investing, which is don't fight the Fed. So I am planning for long-term investments here. The market has gotten a little bit of certainty out of what went on in today's meeting. And of course, it responded in a huge way. So as I'm looking right now at the live numbers come through, it looks like the NASDAQ is up by 531 points. That is 4.4%. So tech is really leading the charge today. I am going to talk about some tech stocks today as far as what some great investments might be, or some stocks that you may want to take a look at. But technology itself up 5.94%, accounting for a really large percentage of market gains today. The Dow Jones up 432 points. We're right at 32,193, almost 94. So Dow Jones is up 1.4%, and the S&P 500 is up 2.6%. The much broader S&P 500 up 2.6% at 102.9 points. So all in all, it's a good day on the markets. We have seen continued volatility over the last 3 weeks, as I've been discussing, but the overall trend line has been up from a low of around 3650 or so back up to around 4,000 for the S&P 500. I think there's an outside chance we make it to about 4,800 by the end of the year for the S&P. I don't think it goes higher than 5,000 under any circumstances. Of course, it's a prediction, and like any prediction, that can be wrong. I don't have a crystal ball, but yeah. So pay close attention to what the Federal Reserve is saying here. There are some worrying signs, though, when it comes to softening in the economy. And one of the things that's happening is the yield curve is flattening. So this represents the yields on U.S. Treasuries starting at 1 month, 3 months, 6 months. You see already the 6-month Treasury is close to 3%, right? And these are, I think these are today's numbers. And you hit that 3% mark again out at the 10-year Treasury bond there. And that is not necessarily a good sign. And you look at the 30-year and it's barely above 3%. So I think today is 3.03%. This is a pretty flat yield curve. Typically what you want to see is sort of you get a spike here and then you get a gentle float upwards. That's typically what we want to see. So we've just now reached a point where interest rates with 75 basis point raise, we just now reached the point where we have a normalized interest rate environment in terms of the federal funds rate. The rest of the treasury yield curve has yet to fall in line. But this flattening of the curve or inverting of the curve, where short-term interest rates are higher than longer-term interest rates, especially at the 10 and 20-year mark, that's generally considered a sign or one of the indications that a recession may be on the way. Although the last 2 times we have had an inversion of the yield curve, there has not been a recession in 6 to 9 months like there normally is. But typically in the past, this has been a pretty solid indication that some problems are about to happen for the stock market. Whether or not this is going to be the case this time, I don't know. I really hope the Fed is able to engineer or guide us towards a soft landing, although typically they have gotten this wrong in the past. And right now, interest rates are pretty much at the top of what is considered a normalized environment. If they raise interest rates by another 75 basis points at the next meeting, that would be considered restrictive. And I think that's probably likely to happen, is that at the next meeting, they're going to raise like another 75 basis points. They may take their foot off the gas between now and the end of the year. But honestly, I don't think so. I expect the federal funds rate to be closer to 4% by the end of the year. And I think that's going to have a significant impact on unemployment. raising it higher than the 3.6% levels that exist today, probably somewhere around the 5% range. And that is a good thing in terms of inflation. All right, so I'm going to bring up my notes here on my other screen. And so I brought up some information on the Stock Act too that we can talk about. I made a comment offhanded yesterday about violations of the Stock Act and how one former congressman was being prosecuted. And some people or somebody emailed me and brought up some interesting points, and I realized a lot of people don't necessarily understand the Stock Act. Um, and there's a lot of trades that lawmakers have been doing around this, which is the passage of the bill for chip makers, right? It's called the Chip Act. So all that information was public. At least as far as we know, all the information was public. There's a lot of trades going on where senators and congressmen are buying and selling chip stocks right now. So they have to actually disclose all of the trades that they're making, not just them, but they have to disclose any of their close family members or anyone that lives in their house. Even federal employees have to report, but they can't do it online anymore, and it's not accessible to the public, but it is accessible to the public if you are running for Congress, if you are a congressman, or if you're a president, or if you work certain jobs for the executive branch. So, yeah. So let's get into talking about stocks. And are we really still in a bear market? If we aren't in a bear market, then maybe your choice of what to look at kind of changes here. But I want to take a look at a few stocks that I think, first of all, that are set to weather kind of any market here. It's not to say you're not going to lose money a little bit, or even a significant amount, but these are set to weather sort of any storms. Number one on that list would be Berkshire Hathaway. Berkshire Hathaway has a market cap of roughly $640 billion. Analyst consensus is a strong buy in most cases. You can buy the B shares, which are, I think last time I looked, they're around $300 a share. Maybe it's about $290 a share now. But a lot of analysts put this at a strong buy. Very few have it at a hold. And the conglomerate here, run by Warren Buffett, seems to just keep trucking along despite the advanced age of the founders. What I worry about with this stock is what's going to happen after Warren Buffett is gone. Who is the designated successor here? They had a designated successor a few years ago. He has since resigned under sort of mysterious circumstances, but a compound annual growth rate since 1965 at 20% makes them some of the best business managers on the planet. They're certainly better managers than any portfolio manager on the planet. That's more than twice the S&P's compound annual growth return in that same time period of about 10.5%. So folks are always telling you can do fairly well in the S&P 500 just by garnering that 10.5%, 10.5% gain every year, which basically means that every 6.5 years or so, your funds are going to double. If you're invested in the S&P 500, you're going to outperform a lot of investors who are stock pickers in this case. My only concern, even though Berkshire Hathaway has a long history of beating the market and beating by the market by a wide margin in certain years, is that Warren Buffett and Charlie Munger are pretty old. They're getting up there. And I don't see who their designated successor is. Okay. So that's kind of a big issue for me. So I'm going to check here and let's see. Don't have any comments yet, but feel free to comment if you guys like. Definitely willing to discuss any stocks you folks have in mind. That is simply number one on the list here. Number two on the list is going to be Medtronic. So this is a pretty low volatility healthcare stock, meaning that it has a beta of usually less than 1. It's less volatile than the overall stock market. It has a solid dividend yield of 2.9%. The analyst consensus here is a buy, and it's actually a stronger buy by analysts than Berkshire Hathaway is. They have a market cap of about $123 billion. So, so shares in this manufacturer of medical devices have lost about 10% for year to date. And at the same time, the S&P 500 shed about 18%. And the average price target is about $114 for this stock right now, and I think it's somewhere around Last time I looked at it, 75 or 80 bucks, which implies a pretty decent upside in the next 12 months or so. That's what they mean when they talk about analyst price targets. So this is a medical device creator. Shares are changing hands right now at about 16.7 times earnings per share. And they're forecast to generate annual earnings per share growth of more than 10% over the next 3 to 5 years. So they have a deep product pipeline, and they're doing a lot of research, and they're also in acquisition mode as well. And a lot of analysts think this is just going to be a growing company. This is also a dividend aristocrat, if that's something that interests you. I'm more focused on total return, but they have increased the payout annually for 44 years and counting. I don't know what their dividend growth rate is, though. Of course, the next stock on this list here is Warren Buffett's favorite stock. And if you own Berkshire Hathaway, then you already own Coca-Cola. This is one of the few names in defensive consumer staples that really can't be matched. They seem to have steadily growing market share. They're blue chip all the way, and they've been in the Dow Jones Industrial Average forever. I don't remember how long, but it's been a long time. And they happen to be an S&P 500 dividend aristocrat. They've got a streak of raising dividends for 60 years and counting. And Warren Buffett has been a longtime investor in this company since 1988. In fact, he bought into this company right after the crash of 1987. And right now, it comprises about 6.8% of the Berkshire Hathaway equity portfolio. So to some degree, rather than, if you're not focused on dividends and you're really focused on total return, I would definitely want to own Berkshire Hathaway over Coca-Cola, but Coca-Cola is a solid price as well. So here's the issue with Coca-Cola in terms of inflation. Coca-Cola has a ton of pricing power, and because of economies of scale. The company was hit really hard by pandemic lockdowns, shuttered restaurants, bars, that sort of thing, live venues in particular. Those sales are bounding back, are rebounding, and as long as we don't have further shutdowns in the United States due to a resurgence of COVID, I think that things look pretty good for Coca-Cola. So that's another one that's kind of on my list here. Another one that I've talked about frequently, but I'm going to hammer on again, is General Dynamics. Market cap about $6.2 billion, dividend yield about 2.2%. But really, I think we're about to go through another sort of generational investment in defense technologies. And a lot of that is triggered by the war in Ukraine. We've simply gotten a lot of data, and we have a lot of new information to process, and a lot of new technologies and methods and devices to develop. We've gotten a tremendous amount of intelligence out of downed Russian aircraft. We know a great deal more about them than we did before. And I think this is really going to spur an investment in defense technology. General Dynamics is not just making airplanes and things like that. They have a lot to do with cybersecurity, a lot to do with communications technologies, a lot to do with anything involving technology at this point. So they do have a robust long-term growth forecast. And their defense characteristics and business strategy has been really well documented. They have gained this year about 7.8%. In the same period, the S&P has been down about 18%. A lot of analysts are issuing opinions that the stock is, they're calling it a strong buy. And they're looking to average earnings per share growth of about 11.6% over the next 3 to 5 years. And I think that's fairly normal for this company. They've just had steady growth for years and years and years. So, yeah. So I like Berkshire Hathaway. They don't pay a dividend, so I don't lose 15% dividend tax being a UK resident. True. And Warren Buffett has been asked over and over and over why he doesn't pay a dividend. And the best answer that he has ever given has been that we'll pay a dividend when we run out of good investment ideas. And I don't know how long it would take for him to run out of good investment ideas. He really didn't do a lot of buying at all in 2021, but he has done a ton of investments in 2022. He's been buying things up left and right, and a lot of that has to do with his value investing philosophy. So Tell 666999 says, love this channel. Thank you. Thank you so much. Make sure to go ahead and like this live stream and subscribe if you haven't. Also consider my Patreon. I think I finally remembered to put it in the actual description. I kind of forget a lot of times. And they say this, I'm a novice, but will interest rates ever be better than inflation? I've always been told to say, but for the last 10 years, clearly I'm losing money. So interest rates have never been over inflation. Never. Okay, so that may not be entirely true. There may have been a couple of times in history where they were higher than inflation, but at least in living memory, in the last 40 years of my life, they have never been higher than inflation. And in the research that I've done, I've never spotted a period where interest rates were higher than inflation, especially things like money market interest rates or interest rates on CDs, even going out to 5-year CDs. They've never been higher than inflation. Between taxes and inflation, if you invest in a fixed income instrument that is something like a CD or a money market fund, you are losing purchasing power. Even if you are buying a like a bond fund or something like that, there is a good chance that you'll lose purchasing power as well, and it will not keep up with inflation. Most people own those bond funds to sort of even out volatility in their portfolios. If you are unconcerned with volatility and have a serious long-term outlook on investing, you may want to reduce your bond holdings to very, very low. So yeah, what companies do you think have the potential to 10x over the next 5 to 10 years? SoFi, and actually, there's a whole slew of companies in the fintech space that I think have a good chance of doing that. I think Affirm is one of those that possibly has the ability to do that. SoFi, of course. Moneyline would probably be an easy 10x right now based on how cheaply they are priced and their pathway to profitability here. And this is, I think I've covered them once in a video, but it's not a company that I talk about a lot. I have a few issues with their whole business plan, but just because I have issues with it doesn't mean that they're not going to be successful over time. And they do seem to be developing a pretty solid community. So Moneyline is one of those. Upstart is another one of those from this point on, which I think they're at $23 or $24 a share today. I can easily see them 10xing over the next 5 to 10 years. And that would literally 10xing would put them 50% back to where no, 10xing from there would no. So, but I can see them definitely 10xing over the next 5 to 10 years. And a lot of what I'm looking at right now is financials. They're set to do well over the next decade in this new interest rate environment. Particularly lenders are. And particularly because there's this giant lag between deposit rates and what you can actually lend the money out for at this point. That's going to start showing up on balance sheets in 2 to 3 quarters. In terms of technologies, I don't think Tesla is going to 10x in the next 5 to 10 years. But I was just doing the calculations today, just running the numbers on production facilities that they have up and running right now, and expansion plans and what they're supposed to have by the end of the expansion plans. But seriously, guys, by the end of 2023, just with their existing models, not adding anything new, Tesla may have like 2,795,000 vehicles that they're able to produce in a year. That puts them at almost half of the production of GM at that point. And I'm not even talking about what I'm talking about their 4 gigafactories that actually produce vehicles. I'm not talking about what they produce in terms of energy storage and solar power and all that stuff. There's no telling what that's going to contribute to the bottom line. It's already a $1 to $3 billion business annually in terms of energy storage technologies for Tesla. And they're really making waves in grid scale energy technology with their megapack systems that they're putting out there. So I do think that Tesla, of course, which is it's something rather obvious that I talk about quite a bit. But let's talk about a few more stocks that I think is I think they're worth talking about right now because they're down, of course. As far as, and a lot of these right now are semiconductor makers. Okay. And the one a couple of them, and in no particular order that I want to talk about today is going to be ASML Holdings. ASML Holdings is basically the supplier of printed printed silicon wafers for the semiconductor industry. They have done particularly well today, of course, but the 52-week range here, they've been as high as about $800 a share. They're down pretty significantly. They went down almost to 428. They're back up to about $550 a share at this point. But this is a company that has a price to earnings ratio of about 38, so it's not really cheap. Has strong volume in terms of trading on a daily basis. It's a dividend yield, doesn't pay a dividend. Days range today has actually been rather constrained, even though the CHIPS bill passed. I'm sorry, the earnings per share is $14.34, market cap of about $227 billion. So this is, I think, one of the safest places to park your money to sort of invest in this new round of investment in the chip industry in the United States, because they're supplying a lot of the printed silicon wafers that people need to make chips, right? So another company that's going to be on that in that same sort of vein there is TSM, and that is Taiwan Semiconductor. It's this is an ADR. It's traded in Taiwan, not in China. Or I mean, the company's based in Taiwan, not in China. They're also building a massive factory here in Arizona, and I've been following the construction of that factory. There are a few concerns about water usage for that factory. And I know someone who's actually probably not going to work at the factory itself, but they do business with TSM and they're relocating from Taiwan to the United States in anticipation of this. The stock today was up about 3.8%. It's about $87 a share. I think this company represents some significant value here. The high in the last year or so is about $151. The market cap is basically about $2.2 billion. So, yeah, I think this is another one of those stocks that's set to benefit from because they manufacture here in the United States. They are also going to benefit from this latest legislation that is out there. And we'll take a look at that here in just a minute. But the next tech company on this list that I think has a good chance of 10xing in the next 10 years is AMD. And look, this is 10xing in the next 10 years. So this is a huge. So it's hard for you to make this prediction on this, especially with companies this large and this established. But remember, semiconductor chips are in everything produced now. Just about everything. Just about everything is going to be a smart product here in the future. The demand for semiconductors is just absolutely going to explode. So, yeah. May I ask, what is your outlook on in the near term? Has inflation peaked? Inflation may have peaked, but it's not going to go away. It is embedded in the system for a while, and there is a bit of a positive feedback loop when it comes to inflation. And until enough people in China, enough people here, enough people in other producer countries decide to invest money into improving supply capabilities, transportation, and production, then we aren't going to see a huge improvement in inflation until that happens. This is a supply shock, just like the last 8 or 9 inflation events were supply shocks. It's people going out and buying stuff and industry not being prepared to meet demand. And so prices go up. This has been the same thing, just after World War II, because everyone come home spending money. Just prior to the Korean War, because everyone was anticipating rationing again, and they went out and bought a bunch of stuff. Just after the Korean War, when more veterans came home and started spending money again, we had a long-term spike in high growth in the late 1960s and high wage growth in the 1960s that caused an increase in demand and some inflation. And then the big shock, of course, was the energy shock, where if energy is higher, then it affects everything in the supply line. So, yeah. So, greetings from Lithuania, Jason. I got a feeling you might actually know who that is. Yeah, I do actually. So, and as an American, I understand that making that statement is perfectly apt. One of my favorite things to watch on YouTube is the dumbest things Americans have said to me. And there are just hours and hours of videos of this. And I get an enormous amount of secondhand embarrassment from watching these, but all of them I know are true. I've traveled enough to realize that we can be a bit closed-minded. But yes, I am familiar with Lithuania, and I've never been there, but one of these days I'm going to go. But thank you. I always like hearing from people outside of the United States. I'm always astounded that anyone actually listens to me at all, or watches these, and I'm very happy to talk about anything you guys want to talk about. So this chips bill is probably some of the most significant, really focused legislation that has been passed in the last year or so. And I think it just got approved by the Senate today. And this article claims that it's far from a game changer given its size. And it really is. It's only $50 billion. And it's called the Chips and Science Act, which includes $50 billion for domestic semiconductor production, research, and factory construction. Many experts now expect the bill to quickly pass the House and be signed into law by President Biden. So, so it was approved by the Senate today. It's got to go back to the House for approval and then go to President Biden here. So if it becomes law, chip makers, including Intel, Micron Technology, and Texas Instruments, and other foreign companies would receive financial incentives for opening new manufacturing plants inside of the U.S. Those companies are the most direct beneficiaries since they have their own plants or fabs that actually build chips. Other chip makers like Nvidia and Advanced Micro Devices rely on third-party manufacturing. So, Nvidia has always been one that's on my list. They're up big today, by the way. AMD I just talked about. But semiconductor stocks across the board were up following the news with Intel rallying 3% basically. Texas Instruments up 6% today. And Nvidia were up about 5 and 3%. So, the $50 billion number looks kind of large on the surface, but the magnitude shouldn't be overstated as it's going to be spread out over the next 5 years. A lot of the numbers that you hear in the media where they talk about 1.7 trillion or 190 billion it's usually spread out over a number of years. I think this is a good investment in I think this is a good investment in our future and a good investment in reshoring some production. Some of that was happening anyway, especially with the giant TSM plant being built in Arizona. But so I think though that it's a positive. I don't think it's absolutely game changing today, and a lot of this article kind of says it. So latest figures have been weak. Worldwide shipments for computers fell 15% in June from the quarter of last year, which definitely says something about semiconductors. But let's think about this. All of the other devices and things that people are buying that have chips in them may make up the difference. We don't know. Global shipments for mobile phones also fell by 9% but due to difficult economic conditions. So these stocks are still a little bit beaten up now compared to where they were last year. They're down anywhere from 30 to 50%. I think it's worth it to take a look at these. So let me know what you guys think in the comments, but I think that's one of the better opportunities for an investment over the next decade is going to be chip makers and financials. Financials is going to offer you a little bit more in the way of stability. Chip makers, they're going to be highly volatile, but trending upwards over the next decade or so, but highly volatile. You're going to be up 20% one month and down 20% the next month. Choosing your entry points and exit points could be key here. Dollar cost averaging right now is not a bad idea. Just because the S&P 500 is over 4,000 right now, I still think that at some point it could drop back to about 3,600 or so. And I think there's even a slight chance that we end up about 4,800 by the end of the year. 5,000 would be a miracle, but I did see one article claiming that the S&P is going to cross the 6,000 mark by the end of the year. I think that's optimistic at best. I think it's kind of crazy at worst. So here's also the thing, and I'm not seeing this article now, but it looks like Meta is trying to here it is. FTC to block VR company purchase from Meta. I don't know how much this frustrates their plans for the metaverse. And it's going to take a long time to truly monetize the metaverse in a way that makes sense for investors. But they're blocking the social media company to stop them from acquiring Within Unlimited, the maker of a virtual reality fitness app called Supernatural. They allege that the proposed acquisition, instead of being done on the compelling merits, Meta is trying to buy its way to the top. Okay. Is that a justification for stopping the merger? I don't know. Will this put them in a place where they kind of control all of the metaverse technology? I don't really know. But the FTC says that Meta has already bought 7 successful virtual reality software companies and owns one of the largest catalogs of VR content. And they said if the deal is allowed to go through, that it might hurt innovation in the virtual reality fitness space. So I'm going to be curious to see what kind of strides they make here. And yeah, so I think that case is something to look at. I don't know if the company that they're talking about right now, I don't know anything about the company they're talking about right now and how they're traded. I don't know if they're publicly traded or not. So definitely keep an eye on that. These cases tend to be settled out of court a lot of times. So taking a look at Veritone here, and I'm just going to take a quick look, Tristan, because it's not something that I don't that I know a lot about right now. But this company is highly volatile with a beta of 3.13, which means it's roughly 313% more volatile than the overall stock market, or at least the S&P 500 here. Price targets on a stock with a volume this low of only 200,000 or so. I wouldn't pay any attention to price targets whatsoever. The 32-week range here has been pretty enormous. They're at the bottom of that right now. They're losing $2.01 per share at this point. So let's talk about this. They do have growing earnings over the years, going from just north of $20 million in 2018 to just shy of 120. They're at $115 million here. I'm sorry, growing revenues rather. Earnings has not grown in that same time period. Main recommendation here is probably a buy with a few holds and only one underperform. So the B of A security is downgraded to neutral. Not sure I would pay a ton of attention to what's going on here in terms of what analysts say. This would be a speculative bet on in this case, unless you have some knowledge that I don't about their AI operations. But this company develops AI computing solutions in the United States and the United Kingdom. It develops and operates something called the AIware platform. It's an AI operating system that uses machine learning algorithms or AI models such as perception, prediction, and problem solving, optimization, as well as cognitive processes, including transcription of language, face detection, recognition, all that stuff. So there's a lot going on in this sector right now. I'm sure there has to be a ton of AI concentrated ETFs out there. It's getting to the point now where I'll take a few concentrated bets on AI technologies right now, like Nvidia. I have a small concentrated bet in Big Bear AI just because I understand how much they have in the way of government contracts. With Veritone, though, I haven't looked into it. Somebody else brought this to my attention a while back. I really haven't looked into it too much. So, yeah. Let me see here. Hey, Jason, checking in from Australia. If Apple report even static numbers, does it appear the last quarter isn't showing a cliff of earnings? Do you think the next quarter will actually be worse? So Apple has something that I struggle to understand on a daily basis. I'm not emotional when it comes to any sort of investment or stock, or at least I try not to be. And if I do catch myself being emotional, I try and cut that out right away. But Apple has brand power that is unparalleled in devices at this point, and brand loyalty that is unparalleled. And it's something that I've consistently underestimated throughout the life of my investing career. I have not made the money on Apple that I should have. I've missed out on pretty much every opportunity to invest when this company was at a low. And I didn't believe that what they were going to do was going to be as successful as it was, largely because I kept making these comparisons technology-wise to their products and to a competitor's product, and discounting the brand power that they have. So yeah, I definitely have some issues here with Apple, but I'm consistently wrong on Apple. Some of their revenues are going to be impacted because of the new data sharing policies that they have. Definitely going to be impacted. Some of it's going to be impacted because of new things that are happening with the Apple Store, where it looks like their commissions are going to be cut. They haven't come out with any new products in a while. It's mostly been improvements of existing products. But even having said that, this is a company that continually defies my expectations and continually delivers on promises that it makes. And they do it on time, unlike Tesla, where they deliver on their promises. They just don't do it in the original timeline that they considered. Apple is a company, on the other hand, that delivers on its promises. So it's not a company that I've followed directly on a day-to-day basis. I definitely hold this in my mutual fund portfolio. It's not a company that I hold as an individual stock. variety of reasons for that. Mostly I just missed the boat on those. So yeah, happy to talk about any other stocks you guys want to talk about, but I'm going to talk about a couple of other big tech opportunities we have right now. And one of those, of course, is in here. There are a few ways that you could disagree with this as well. Uber Technologies, I think, might represent a pretty significant opportunity. And from this price point, I think it almost certainly represents a 5x opportunity in the next 5 years or so. And one of the things that could be viewed as a negative, but is actually sort of a positive here because we're seeing pricing really align with the cost of its services, is that these companies like Uber and Lyft and a number of other Silicon Valley companies have been really running off of venture capital money for a decade now. And the price of their services has been subsidized. Now, in an inflationary environment, prices are going up. In this case, it's closer to what the actual cost of their services are, and they don't necessarily have to dial that back if inflation comes down. It was always understood by most people investing in Uber that as we saw wider adoption, they would have better economies of scale, but that prices were still going to be under what the actual costs of the services were, and they were going to have to come up at some point. I think that Uber is going to take full opportunity to do this, and they probably have a better pathway to let's just take a look at some numbers here and some trends, because it's been ugly for the last couple of years, even though they've been a really celebrated company. So after hours, they are down here to $22 per $22.95 per share. So they have a market cap of about $45 billion. Honestly, not sure how much of that is justified, right? They have a beta of about 1.31, so it's a little bit more, about 30% more volatile than the overall market. Negative earnings of $3.33 per share. That's been the same for a while. Price targeted in this case about $48 a share. He's in line with what I just said earlier, 5x in the next 5 years. Lyft also is kind of in the same boat, 5x in the next 5 years or so. Earnings per share, it's hit and miss with this company. Earnings have largely risen, with the exception of 2020. Of course, that was due to the pandemic, of course. But 2021 is where they really firmly demonstrated that they have a pathway to profitability. They reduced their loss from about $6.7 billion in 2020 to $496 million in 2021. There's a lot of reasons for that, but the repricing, what they're doing, improving their algorithm for pricing as well, I think that has a lot to do with it. I even think that the competition from Lyft to a degree has kind of benefited them. But so I do think this is a pretty good opportunity for the next couple of years. Lyft has similar numbers. They are more volatile, similar numbers in terms of how I expect them to grow, but this is a much smaller company, and I think they have a lot more room to grow here. They're a significantly more volatile than Uber is. 1.88 beta, market cap significantly smaller, about 10 times smaller, of about $4.6 billion, and earnings per share of negative $2.29. So 52-week range, they got as high as $57 per share. I see them returning to that in the next 2 years fairly easily. This may actually be a case where I end up buying a Leap contract on this company at $6 or something like that, which means in the next 2 years, there probably won't be any liquidity for that Leap, and I'll have to exercise those shares. But I'll be buying a deep in the money call on the stock, and I'll be using about 40% of the purchasing power and getting close to dollar for dollar. You're never going to get 100% dollar for dollar participation on the Leaps option, but you can get it at over 80 cents on the dollar fairly easily by buying a really deep in the money call. It costs you a little bit more upfront. It magnifies your earnings on the back end. One of these days, I got to do a video on Leaps. But we'll talk about that. So, and my internet connection stopped cooperating here. So earnings, they've got a little bit more consistency in terms of meeting their consensus earnings per share. That has less to do with, I'm saying that Uber is a little bit more volatile. It may be that the consensus earnings per share were just poorly done for Uber and better done for Lyft here, but they've got solid beats on earnings for the last 4 quarters. Their revenues don't look terribly different than Uber, meaning they had growing earnings. 2020 happens, they're back. They've started to decrease their losses. They've started to decrease their losses. Looks pretty good. Mostly, it's a strong buy or buy recommendation. A few holds and at least one underperform. So, So I think that Lyft and Uber are good picks here. The big danger to them both, and I know they're both probably working on this too, is a driverless taxi service. Something that people who look at Tesla are talking about. This would be serious problems for either Lyft or Uber. My issue is full self-driving taxis. Do they really happen? I'm still unclear as to whether or not they actually happen. And I know that I'm getting conflicting information from people that I know that work in autonomous technologies and people who are investors, and it seems to be that they're on they're separated by a wide moat here. The differences of opinion. There's not a lot of people that are kind of in between that are like, oh yes, it's maybe going to happen. No, it's probably not. So, Let me see here. George from Greece says Micron and Intel have low PEs with a dividend based on US. Also, Qualcomm partners with Intel to make chips for them. Could this be a geopolitical trend? Yeah, I think you're correct in that, George. That is almost certainly going to be a geopolitical trend, as it's not just governments and people that are upset with supply chain disruptions. Disrupting supply chains in China has gone a long way towards hurting the business of Micron and Intel for a lot of reasons. But you are absolutely correct. The PDE ratio is astoundingly low. It's 7.11 for Micron at this time. It is a little bit more volatile than the regular stock market, about 28%. Target prices, though, are not really out of range here. And if you look at the 52-week range, you haven't really seen this company get enormously beat up right now. It's right in the middle of its 52-week range. But this company has been, in the past, a fairly solid investment. 4 out of the last 4 quarters, they've beaten earnings just barely. Their earnings per share. Their revenues have kind of been all over the map here. Their earnings have been all over the map as well. It has been positive earnings, though. This is a company that has actual positive earnings, which is something that we don't talk a lot about on my channel because a lot of us like risky stocks, some of them that are a little too risky. And one of the things I'm probably not going to be talking about so much are pre-revenue stocks. I talked about a lot about that like 2 years ago because I really just get excited about technologies. And if you notice in those videos, I never tell anyone to buy, sell, or hold any security. I can't do that. But especially in those early videos, I really didn't make any recommendations whatsoever because I realized that these were mostly like pre-revenue stocks. So, and this goes for a lot of EV makers, guys. I got a question about Lion EV that I didn't really address in the comments. I just haven't had time. Or a Lion Electric company, and we'll take a look at this right here. But this is one of the companies that I think is a purely speculative bet here. The earnings per share right now is a negative 14 cents per share. They got a market cap of about $900 million. Volume in this company is actually fairly low. It's not as well known as a bunch of other EV stocks out there, unless you're really into EVs. They are politically, they're making a lot of noise. They've gotten some good press coverage. But when you take a look at earnings here, and let's see if this is going to cooperate and come up, it's not going to come up. All right. So I'll wait just a second here till that comes up. But when we take a look at earnings, revenues, and that sort of thing, it doesn't look good, right? This is basically a company that doesn't have a lot in the way of revenues. They're spending a lot of money at this point to get ahead, and it doesn't seem to be. I think this company, along with companies like Canoe, along with companies like even Lucid, they have a pretty narrow path to walk towards success. Lucid, I think, might get acquired at some point at a really fair price. I think that Lion Electric Vehicles, I think that what was it, Workhorse, and a couple of other companies, Canoe, are probably going to get acquired for pennies on the dollar. Arrival might be one of those too, and I really like Arrival's manufacturing strategy. I thought it was pretty cool and pretty unique. Nikola is the company that I don't understand why they're still around. I really don't understand why they're still around. Although I'm willing to entertain them a bit more now that Trevor Milton is long out of the picture. But yeah, so ZEV Lightning E-Motors is another one where I just don't have an opinion on this company, to be honest, because there's not enough known about them. So yeah, happy to answer questions and fire away. I'm going to go ahead and talk about a couple of other companies on the list here. And let's talk about this company. We're going to talk about Octa Inc. here. And so I've been taking a look at cybersecurity companies lately. Octa is one of those. VeriSign is one of those. Juniper Networks is one of those. And Juniper Networks used to not be considered a cybersecurity company, but it kind of is now. And so definitely taking a look at all those companies, largely because I think this is not, it's not an emerging industry. It's one that's fairly mature, but it's one where the investor experience has been pretty rocky and uneven for the last couple of decades. So I first got interested in cybersecurity companies back in the late 1990s, and pretty much every investment in those companies ended up going bust. It really didn't do very well. So Octa is not a pre-revenue company, but they are definitely a pre-profit company. Relatively stable in comparison to the regular market cap with a beta of about 1.05, which is acceptable risk for a lot of people. Earnings per share is fairly negative at negative $6.37 per share. Volume is really healthy in the stock, roughly 3 million shares trading per day on average. They have a lot of well-known names here that people watch as well. They're beating earnings 4 quarters in a row. Earnings have been estimates have been all over the board though. Their revenues have just increased over the last couple of years, but so have their losses. And I don't know enough about this company to understand why their losses have increased. Of course, it's investment in everything they're doing right now. We look at the 52-week range, though, they are down pretty significantly. This is another one of those opportunities where this is the case where I may not buy a leaps option on this company. I may not do that. But I may and I may not. But this is one of those companies where I think that their success and their pathway to profitability might be a little bit less secure than some of the other companies that I've talked about. This is definitely a pre-profit company. It's very hard to evaluate the value of future cash flows right now based on a rising interest rate environment. But yeah. So George, let me address one other thing you had in your comment here. So low PEs with dividend and based on the U.S. So dividends in the U.S. tend to be lower than they are in Europe. And a lot of that has to do with the fact that companies who pay dividends right now in the last 2 decades have spent a lot of money with stock buyback programs, which helps support the stock price, of course, and the fact that companies do not get a tax deduction for paying dividends in the U.S. I don't know if that's the case in Europe or not. And so in Europe, of course, they traditionally pay a higher dividend. So I think average dividend rates for large cap stocks in Europe are anywhere from 3.5% to 4%, where in the US they're more like 1.92 to 2.25, something like that. So Divyesh Patel, any thoughts on Nvidia for the long term? So I'm actually hugely bullish on Nvidia. I talk about it on my channel all the time. I talk about how many different lines of businesses they're involved in. And I talk about how I think that that almost certainly, I can't really say almost certainly, but I think there's a good chance that that Nvidia becomes the largest component of the S&P 500 in the next decade. That's how large I think this company is going to grow, and that's how successful I think they're going to be. And so so I have looked at this company a number of times. And I've actually passed on making videos on this company. I don't know why I pass so often on making videos on this company. This is definitely a penny stock here, so it's not something that I would make a video on normally. I've only done that a couple of times, and for a couple of different reasons. There are actually more restrictions on what I can say about penny stocks as a financial professional, and I can get in a lot of trouble by talking about them. But I can certainly talk about the facts. The beta for this company, I think it's because the price is so low. has been 0.11 for the 5-year monthly. So it's far less volatile than the actual stock market here. Earnings per share is negative. Hold on, let's see here. They had basically 1 year of really good revenues, and then they basically crashed since then. So, and by the time people started asking me about this company in 2020, I already had serious reservations about this. I don't know why there's any sort of recommendations at all. But this company, Ideanomics, focuses on the adoption of commercial electric vehicles, associated energy consumption, developing financial services, and fintech products. Its Ideanomics mobility division facilitates the adoption of electric vehicles by commercial fleet operators. So I've tried to dig into their business model, and it's a little unconcentrated. And it's a little unconcentrated, and I don't feel like they have a very good focus or identity. And so I have some concerns about this company. My biggest concerns here are this right here: the giant drop in revenues, down from 377 million down to 44 million in revenues, and now down to 26 million in revenues. So do I think this company is going to bounce back? I think it's unlikely that it bounces back from this point. So any improvements on Google's Gato AI? Is that the AI that one engineer was saying is sentient? Because I did read an article on that. And an engineer is saying that, first of all, I don't know how you would actually evaluate whether or not an AI is sentient. If it can fool you into you believing that it's human, does that mean it's sentient? I'm not sure that it does. I think mimicry can get good enough to do that all on its own. But like, I don't know if firing that guy was the right thing or not. But I do think that any claim that an AI is sentient should be investigated, because I don't believe in slave labor. That's number one. But number two, there would have to be, and this sounds crazy, but if they were judged to be sentient, you would have to compensate them for their labor. How do you compensate an AI for labor if it is sentient, right? Or do we just simply endorse slavery? I don't think we're going to simply endorse slavery. There's going to be a whole question of rights for sentient beings. Although knowing humanity and the fact that that Homo sapiens sapiens eliminated all of our competition, either by reproducing them out of existence or by exterminating them, I do think that there's a good chance that we will just simply shelve those thoughts and never address them. And that is an ethical issue that I probably won't get into on my channel, but I think is really fascinating to think about. Should be like a Star Trek episode or an Orville episode or something like that. So I'm a fan of both. I'm a giant nerd, guys. You know this. I think you figured this out already. So but I think if the Gato AI is the one that one of the engineers was claiming to be sentient, I want to know more about it. I want there to be an investigation on that, and I would have a lot of questions about what this says about the future of AI technology. So, yeah. So big news today from Cathie Wood. She dumped all of her Coinbase holdings after the I think it's the FTC or the SEC, one of those two, initiate. Oh, here it is right here. Coinbase's woes are too much for Cathie Wood. And let me see here. By the way, guys, this is behind the paywall at Barron's. I don't know if they're eventually going to get pissed off because they keep sharing articles from behind the paywall here. But this is what your Patreon dues pay for, is access to my premium news sources. And a couple of them I actually can't put on a live stream. They do specifically say that I can't share. So, So it says now that one of the even bravest riders of the financial roller coaster is looking to get off. Cathie Wood's ARK investment, once fully bullish on Coinbase, sold the stock across 3 of its exchange-traded funds on Tuesday. It was the first time that ARK sold Coinbase all year. On the same day, the share said 21%. And the Coinbase has lost 79% of market value this year. And man, this is a company that I was big on because Coinbase had been profitable for years and years and years. It was not a unicorn coming public where they had a lot of companies in the last couple of years going public by SPAC are pre-revenue companies or companies who have never made a profit and don't have the likelihood of making a profit for 5 years or so. Coinbase was not one of those, right? They debuted at like $381 a share, and they've lost close to 80% since then. So definitely not what anyone who invested in that would want. But yeah, they owned 9.1 million shares, around $658 million. It all changed on Tuesday when they all sold their funds. And it all has to do, I think, with the collapse in Bitcoin, of course, which oddly enough, there hasn't been a collapse in Bitcoin trading. That seems to be relatively stable. But Bitcoin or Coinbase itself has shown it to be somewhat correlated to the price of Bitcoin, or at least sensitive to the swings in the price of the token. So declines in crypto often usher in lower trading volumes. This has not actually been reflected in there's been some slowdown in trading, but it's still fairly wide. And if you look at crypto as a whole and trading activity as a whole, it hasn't slowed down that much. But it's about regulatory pressure, particularly from the U.S. Securities and Exchange Commission. I think it's only a matter of time before crypto gets some sort of hybrid recognition by the Securities and Exchange Commission as a security at this point. Right now, it's not recognized as a security. I think at some point they start, So, but right now they're looking at whether or not they let Americans trade tokens that should have been registered as securities. Right now, they don't include them as securities. That's looking to change sometime in the future. So, hey, Jason, random question. You never seem to be tired. Keep going like a machine. What is your fitness regime? Thank you. So, I'm a black belt in Brazilian Jiu-Jitsu. I own an academy, and I train at least 3 times a week. I know some people train every day. At my age, you can't train every day. But also, I do a lot of walking. I stopped running a few years ago when it got hard on my joints, and especially when I figured out that you can you burn for about an hour of walking, you're going to burn right at my size, you're going to burn roughly about 200 calories. For running that same distance, you're going to burn about 300 calories with a lot more wear and tear on your body. So I'd rather just walk for an hour and a half than run for an hour. It's a lot less hard on your body, and it burns about the same amount of calories. I try to get in at least about 5 miles of walking a day. I don't do any weightlifting or anything like that. Not seriously, at least. I have about 80 pounds of weights at home, and that's it. And I throw that around a couple of times a week too. But being thin when you're older is 90% diet and about 10% exercise. I do exercise because there's all kinds of other benefits besides keeping the weight off and having high energy. But mainly it's about diet. Calories in, calories out. Try to stay under what your maintenance calories are. I've actually struggled with my weight my entire life. So very interesting. Oh, another interesting note, I will not be on the air tomorrow. One of my biological relatives is coming into town, which I don't know very many biological relatives, and this is kind of a unique story. So I met him through 23andMe, and we didn't share very much DNA. And 23andMe is also a publicly traded stock. It's one of the things we should talk about too. The product of 23andMe is not the DNA test that they give you. It's your DNA. That is their product. That's what they're looking to sell to research companies out there so they can use AI and deep learning to gain insights on that. But that's beside the point. So he was looking for his biological father who he had never met, who had probably the most common name on the planet in the United States. And so he had never been able to find him. We only shared about 1.6% of our DNA, which is not close. And a lot of times, if you share that little DNA, you're never going to unravel the relationship. But on my side of the family, I had a couple of breakthroughs, and I was able to figure out who my biological parents were, and particularly my biological father's side of the family, who's related to his. Well, I'm actually related to both sides of his family. That's a whole different story, I guess. But I basically found out that my grandmother and his great grandmother were sisters, and that took almost 6 months to unravel that. But we've been, basically acted like family ever since then. I went and visited him in northern Alabama last year, where I discovered that Huntsville, Alabama may be a great real estate investing opportunity for a lot of people. Every military contractor that exists here in San Diego also has offices in Huntsville, Alabama. There's a university there as well, and there's a growing intellectual community there as well. I seriously think that may be one of the next great real estate markets is Huntsville, Alabama. So, so he's coming tomorrow with his wife, and I won't be on the air tomorrow, but I'm happy, and I will not be back probably till Tuesday. I'll try to drop a regular video on my channel between now and Tuesday, but we are going to be partying, my friends. we are absolutely going to be partying. So I'm going to probably do a day trip to Mexico, have a good time, going to hang out at my bar, have a good time there. Going to teach him how to surf if that's possible. I don't know how athletic he is. Maybe take him to the jiu-jitsu academy and have him fight a bunch of women who'll tie him in knots. That's one of my favorite things to do. Take guys into the gym and let my girls choke them out. So it's really fun, but it humbles people real quickly. Michael Will says party till you drop. So normally every summer I party till I drop because my family goes to Japan for a couple of months. So I get to, imagine that I have no responsibilities for a couple of months. So every summer is party time for me. So don't think that I'm a monk when it comes to fitness or anything like that. I'm definitely not. I like beer. I like partying. I just don't have a regular schedule. So I'm able to kind of sleep whenever I want to and work whenever I want to and that sort of thing. And that's what keeps me energetic. I do these live streams not because I make a ton of money out of them. I don't. You make more money off of videos you make for YouTube. But videos are a lot less fun than the live streams are. And I really just like talking to people on the air, having them bounce ideas off of me. I get a lot of great investment ideas from you guys, right? It's not a one-way street. When you comment things in my channel, I may not talk about them on the channel as much for a variety of different reasons, but usually it spurs an investigation. I've learned lots of new things, particularly about different technologies that are up and coming, got lots of ideas. It's all been through comments on my channel. So there we go. Brilliant. Thanks for Life's Insight. YouTube can really be impersonal at times. This is so great and great for mental health. Mental health is something that I've never addressed on my channel, but that's gotten, there's kind of been a trend started lately. It's okay to not be okay, folks. Take a mental health break. When you're feeling stressed out, take a day off of work. If you have 2 weeks of vacation at your job, and I know I worked in the corporate world for a long time, and in the corporate world, I never had more than like 17 days of PTO and a paid time off rather. And most of the time I had less than 10, but I took every single day, even though there was always pressure. You were called not a team player if you took all 2 weeks of your vacation. I can tell you this right now, for your own mental health, and this is the hard truth, no one cares how hard you work at work. Not for long. The gratitude doesn't last. If you work super hard, you put in 60 hours a week, the company really benefits from what you do, and then you have a hard time and you don't produce as much, they're not going to remember all of the good you did for the company if it's a large company, if it's a really large company. If it's a smaller company, they might do that. And when the hard times come, they're going to do the math on your age and how much you're paid. And if you are middle-aged and high earning, you're going to be the first person they let go. And because when the company recovers, they're going to hire someone that's younger. So take all of your vacation time. Take all of your mental health days that you need to. Enjoy your life. Don't live to work, work to live. So very much. And I took a very European attitude towards working for other people after I lived in Europe for a long time. But since I've worked for myself for the last 6 years or so, I definitely work harder than I ever have. The difference is I actually enjoy it. Right. So, there we go. 2 weeks is abysmal. We get 28 days or more generally in the UK. So generally, most Fortune 500 companies give you 10 vacation days per year and usually like 3 to 6 sick days. Use all your sick days, use all your vacation days. I worked for a really good financial services company that gave us like 17 days right off the bat. They gave us like another like 3 days just kind of generally. And but that covered sick pay. And so it was 4 weeks of vacation per year, and that covered sick and whatever. But that was the most I ever had working for the private sector. Now I take a minimum of 6 weeks off per year. And that's better. I actually earn a little bit less money than when I worked in the private sector for or when I worked as a government services provider as well. But I take more vacation. I live my life better. I take afternoon naps, and you don't know how much I enjoy taking a 30-minute afternoon nap. But yeah, so and that's the thing. If you're still working in the corporate world, just remember that they don't have any gratitude whatsoever, none whatsoever. So, and I remember, Michael Will, when I lived in Europe, I knew a dentist who's from Norway, and he got 19 weeks paid vacation a year. Now he was in his 60s, good guy, in his 60s, but got 19 weeks paid vacation per year. I knew people that worked in factories that got 6 weeks paid vacation per year, and they used it to the utmost. Usually, everyone in France takes the month of August off, and they go spend that entire month, usually in the south of France or in Spain or somewhere like that. But yeah, I think it's absolutely abysmal that we require people to work themselves to the bone here, and there's this constant argument over living wage. And I keep thinking about this argument logically when it comes to living wage. Like, why does one job deserve a living wage and another one doesn't? So many jobs that people had in the corporate world where I worked, like people who worked for me, they didn't have any more training than a McDonald's employee does. And yet the McDonald's employee was making $7.65 an hour, and we're paying this employee $40,000 a year. So just for that's about $15,000 a year for the McDonald's employee, about $40,000 a year for some of the people that worked for me. This is a number of years ago. But when you looked at the actual time it took to train these people, what I was training them on, in the job that because I used to work in fast food also when I was a kid, when I was a teenager, they weren't doing anything that was any more difficult than a fast food job. So why did they get a living wage, but the fast food people don't? Right? There wasn't a logical reason to believe that. It wasn't about training. It wasn't about job skills. These were job skills that I could teach you in under 100 hours, right? In both cases. So you probably get a good 40 hours of training for at a McDonald's restaurant today in total. And I was probably giving these people well under 100 hours, usually like 50 to 60 hours of training. That's it. And yet they were making $40,000 a year. There's a huge difference in the type of people that got those jobs, though, and that's where I think that the difference actually lies. So, so your loyalty should be to your career, your own advancement in on the economic scale here, working your way up the ladder, and that's really what you should consider as you're working forward. And you can say that I'm just scarred by working in the corporate world, but if you're young enough, you'll get there too. You'll realize the first time you have a really big disaster and you need your boss to be considerate of what you're going through, and they're not. And none of that, no one above them is either. So, So are you getting Starlink? So there's supposed to be an improvement in my internet speed here. So I'm gonna wait on Starlink. I don't want to get something just because it's cool technology and I want to. I want to see if, number one, if I can get it in my area. Number two, how that's going to work. I did talk to a van life person who was just camped out in the parking lot of one of my businesses, and he has a Starlink uplink, and he actually like works out of his van, which kind of surprised me. He does like internet marketing or something like that, and does fairly well. But in Southern California, there are just tons of van life people, because housing prices are so high here, So anyway, I am going to call this one a day today. I didn't get to all the stocks I wanted to talk about yesterday. I didn't get to all the stocks I wanted to talk about today, but I did want to say thank you for coming on again. As always, the super chat features are on. Nobody indulged today, but I don't do this for the super chat. I do this for my own entertainment. Happy to hear from you guys as always, and I will see you next Tuesday. Thank you very much, and have a nice weekend.